Hello, traders. It is Sunday morning, December 29th, and this is my last video of the year. We have had an incredible year. We have been bullish all year long. From January last year, I told you, buy, 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 add, add, add. It wasn't until early summer that we started to take risk off. The price action was telling us that the move was getting a bit overextended. That was a good time for us to take profits, especially heading into earnings season in July, FOMC meeting, and then the typical dead spot that we see in August, September, October. And so during that time period, we were pretty sidelined, waiting for any kind of decent market dip. We actually got one. We had a big, strong rebound from it. So we knew pretty much from the first weeks in October that we needed to stay long. And you can see how the price action since that time, so right here we're getting into August, September, and this low right here, and the way that we made a higher low and the fact that we challenged the previous high told me that this was going to be a nice entry point into year end. So we hit this little resistance level. Let's take a little bit of profit. We've got the elections coming up. We get this little pullback. This is going to be a buying opportunity. Elections are typically resolved to the upside, meaning that regardless if Democrats or Republicans win, we should see a rally. We got that rally, and we got a little bit of follow through. This is where I had said we need to take gains. I don't like what I see. I feel that there is limited upside and much greater downside. Let's go to cash. We've had such a big run during the course of the year. Let's lock it in. Why risk it? And then we got this drop after the last FOMC statement. The Fed is not going to be as dovish as everyone had hoped. So for more analysis on how I see Q1 of 2025 playing out, please watch the video that I posted a week ago Sunday. That has my first quarter analysis. A lot of fundamental information. The fundamental backdrop is deteriorating, in my opinion. I don't like the price action either. You can see how this last leg of the rally has come on very light volume. You can also see how the dips are becoming much more frequent. Every move higher is instantly challenged. That's a sign that there's selling pressure. Okay, what we want to see is this type of price action where it's nice, tight, moving higher on heavy volume. Okay, this is what we really want, and this is when we ramp up. This is when we size up. This is when we add, and then as soon as that price action starts to stall out and the momentum stalls, we start taking gains on our long positions. We evaluate the dip. We see just how far that dip reaches down, and then we wait for signs of support. Once we're back up above the 50-day moving average and AVWAP-Q, this is a beautiful entry point, and look at that beautiful price action. So what I'm going to do today is I don't have a pick for you. I've decided I'm not going to give you one because I've been telling everybody to be on the sidelines. I don't like what I see here. I need to see a dip, a nice sustained dip, not just a one-day wonder where we get this long red candle. I need to see more time and more probing of support. This looked like a little bit of a double top in here, but you can see how this long red candle, we actually got above the halfway point, almost to the open of that long red candle. So we got a bounce that was a little bit taller than I had hoped, but it's year end. Asset managers want to mark portfolios up. There's a decent chance that when we start the week, Monday and Tuesday, will probably still be fairly bullish. With this type of price action, with what I see on a macroeconomic basis, could we see some profit taking? Because investors are going to hold off on taking profits so that they can take their capital gains next year. Yeah, we could see a little profit taking in January, especially with a market run-up of this magnitude, and especially with the valuations being very stretched, and especially with the Fed talking about only easing maybe twice this next year. That's reduced from 4 rate cuts this year. So a little bit more on the hawkish side. So let's see what plays out. So if I'm going to be giving you all sorts of picks today, then I'm not really staying consistent to what my overall message has been, which is stay in cash. Let's evaluate the price action the first few weeks of January. Let's see if we get that dip. If we get that dip, let's see how deep it is, what the duration is, and the shallower and the briefer it is, the better. If we can't even get down to the 100-day moving average and we bounce instantly off of it, I'll view that as fairly bullish. If we start waffling around the 100-day moving average and poking above and below it for an extended period of time, well, then there's a good chance that we're going to actually visit that 200-day moving average. So what I'm going to do today is I'm going to do a little bit of technical analysis. As all of you know, I'm writing my book, and the first section of the book is long-term market analysis. We go through the fundamentals, and then we go through the long-term technical analysis. So I'm going to apply some of those lessons. I'm going to try and keep this video fairly short, because what I really want to do is to show you how simple it is to perform this technical analysis with just a couple of tools and with the ability to read price action. We don't need anything else. So if you're littering your charts with all sorts of indicators, knock it off. All they're going to do is confuse you. Focus on price. So first of all, CELH. That was the last pick that I gave. It was on the bearish side. It was about a week and a half ago during one of the live events. And so you can see how the stock has continued to drift lower. And we had this nice breakdown in here. So stock is progressing as we would have expected. But that was, again, about a week and a half ago. And it was just more for day trading than anything else. So let's take a look at the long-term market analysis. I'm going to provide you with some very easy tools. First, I'm going to go into studies, and I'm going to take off some of the things that I've got up here so that we can focus on a very important concept. So if we go all the way back, we're going to look right here at this specific point in time. And you can see that this light purple line is the 50-day moving average. The dark black line is the 200-day moving average. And this cross took place February 3rd, 2023. Once we had this cross, we would look back and ask ourselves, this is a golden cross. This, in my opinion, signals the beginning of a bullish market trend. And at this stage, it's actually a trend reversal from a bearish trend. So you can see if we scroll back, this was the market decline in 2022. And so you can see the price action starting to chop around. And now all of a sudden we see marginal new lows. We see taller bounces. We have a higher low, double bottom. And once we get through this horizontal resistance from the first bounce, which is right in this level here, okay, now we start shifting into bullish mode. This is a bullish market cycle that's setting up. Right here, we had a cross below the 200-day moving average. Right here, this is a death cross. Now we start getting bearish. We've got a rally up, and the market can't challenge the previous high, and it drops back below the 200-day moving average. This is where you would short. Now, there's a very effective strategy that I use. Haven't talked about it much. I do use it a lot, and it's one of those things that came to light when I started writing about what influences me when I'm trading. When we get into a bearish market cycle, what I like to do is I like to take the low from this bounce right here, and then I measure to the top of the bounce. And this distance is what's called a measured move. So I will take this distance and I will subtract it from that low, and it puts me down into this range right in here. Well, I would short here. I would add on confirmation below the 50-day moving average. If there's any other moving average in here, I would add on that. I would add on a breakdown below that horizontal low. So I'd be adding. But on a bearish move, I'm looking to take gains quickly. I'm not waiting for the bounce because these bounces are violent. There was even a nice violent bounce right in here that you had to weather, but you had everything telling you that we should be able to continue lower, especially since that 50-day moving average provided some resistance. We get down to this point, and now you've hit your measured move. You don't wait for a bounce. You take your gains. So now if we were to apply that same principle, we can see that these bounces are really pretty tall. So that tells us right off the bat that even though we're in a bear market cycle, this trend is not very strong because we're seeing these big bounces. And in a bearish market, you do tend to get really big, tall bounces because buyers are still conditioned to buy dips, buy dips, buy dips. So now we get a massive rally up to the 200-day moving average. This is a strong rally. So our ability to read price action is critically important. We don't want to see giant snapback rallies like this in a bearish market. We want them to find resistance at the 50-day. We want it to stay well short of that 200-day moving average. The fact that the market was able to bounce that high already tells us that buyers are still fairly aggressive. So we come off that 200-day moving average. We've got a downward sloping trend line. We can short in here. We can short on a breakdown below the 50-day moving average. But now all of a sudden, we get down to this horizontal support where we would be tempted to add, and we could add. But as soon as we take out that low, we start seeing big bounces and volatile price movement with very little follow through. So this is where I would start taking gains. Again, horizontal support, previous big, tall, massive bounce tells me that buyers are fairly aggressive. So I've got to be super careful when I'm shorting on a longer term basis because the market has gone up for 100 years. For 100 years. The trend is super, super strong. Look at a 100-year chart. Look at a 50-year chart. Look at a 20-year chart. Look at a 10-year chart. It's straight up. So you're always on pins and needles when you're in a bearish market cycle, and that's why we use these measured moves. So we're taking gains in here. I don't like this choppy back and forth. I'm not getting the follow through that I needed. And when I do add to positions, be it bullish or bearish, I'm looking for instant follow through. I need to see that immediacy. I need to see that sense of urgency on the part of buyers and sellers. If I don't see it, my odds start going from very high to 50-50. I don't want to be in that type of situation. So I'm going to take my gains. And from here, you've got actually very nice big gains. So now we get another bounce, a fairly tall bounce up to the 200-day moving average. And you can see on this drop, we make a higher low. So if I'm shorting in here and I see I'm short and then, ooh, we bounce right away and now we're back below it. Okay, well, I didn't really need that retest right in there. And I'm starting to get more cautious because this was a marginal new low. We didn't go donk, donk, donk and fall apart. That's ideally what we would have seen from a bearish standpoint. But because the price action here was very stubborn and we had a marginal new low, it tells me that buyers are not far away. This market's going to be pretty dang close to reversing in here. And then finally, we've got the higher low, double bottom, and now we're starting to get through this horizontal resistance, the top of the first bounce, and we've got that 50, 200-day moving average crossover. That is our golden cross. So the reason that I'm spending so much time on this is because from this point forward, right here, we are in bullish cycle mode. And our complete thought process is from this point forward, I don't care what happens from this point forward, I am in buy the dip mode. When I get that nice release and I get that nice rally, then I'm going to start taking profits when I start to see signs of resistance, and I'm also going to use measured moves to help me do that. So if I take a look at this move right in here, so now I've got a measured move from the low of this dip to the high of this peak right in here, and I take that value right there, there's the high and there's the dip, there's my measured move, I'm going to add it onto the top of this. And that's going to give me a target. So you can see, gosh, that coincides beautifully with that temporary high. Okay? So what I'm going to do from this high to the low of this bounce is I'm also going to draw a measured move. That distance from there to there, I'm going to add on top of that. And trading programs and algorithms, they're all mathematically based. So this is just a very easy and very effective way of giving us an idea of how far this move could go. If I add that onto the top here, it's going to take me right into this level here. So it's a perfect way for me to gauge when I should be taking profits. And of course, I'm going to be watching the price action. Look, the candles are mixed, they're overlapping, we're starting to lose some of this momentum here. This is a good time for me to take profits and wait for a dip. Oh, there's a dip. Oh, okay, measured move. There's the high from that previous move. There's the low from the dip. I'm going to measure this distance right here. I'm going to add it onto the top of that. And guess what? Ooh, it lines up beautifully with that area there. See how easy? Isn't this easy? So now I'm out and I'm waiting for the next dip. Ooh, this one was pretty dang deep. Okay, so we're going to be watching it. I'm going to add some other lines to it, but I want to complete this thought. I take that high, I take that low. That is a measured move. If I add that onto the top here, I get right up here, and that takes me to about the 615, 617 level. Okay, that is my upside target. Well, when I start seeing this type of topping formation, there's not a lot of momentum, very light volume rally, tiny candle bodies. I'm only about 100 S&P points from, and actually I think we might have been 70 or 80 points from that target. And I start to see this kind of garbage, and I start to see all these dips, rally dip, rally dip, rally dip. It tells me that there are sellers nearby. Why would I wait? Let's just take our gains a little bit early. We've had a great run, got a measured move coming up. Let's see what happens next. So I'm going to add a few more moving averages to the chart. And every time that you add something to the chart, it just does something to traders mentally. But you can see how clean and beautiful this chart is. And then if I add some measured moves in here, and I'll probably end up adding an indicator that allows us to click, click, and when I do this type of motion, it'll add this height onto that candle. So it'll be kind of a backwards deal, I believe. I could do it forwards as well, but anyway, it would add up here and give us a dotted target line so we can see where those measured moves are coming into play. You do want to do this for larger dips. You can use it here, okay? And that's going to put you in here. You could use it here, and that's going to put you in here. So you can use it for smaller dips, but if there's a dip on a chart that's very apparent to you, that's really where you should apply it. And so on the way down, just to show you how well this works, okay, there are Fibonacci extensions and retracements, and there are a variety of different levels where the market could find resistance or support. This is much, much easier. So I use it. And it's not something I have to spend a lot of time on. It works really well for indices, okay? So it works great for the S&P 500. It tends to work really well for futures contracts as well. It doesn't work very well for stocks. And the reason for that is that stocks have a mind of their own. They trade much more on the fundamentals of that individual company and money flows in and out of that stock than they do on measured moves. But when you've got 500 stocks and they all move independently of each other, now all of a sudden this is a very thick index and institutions are very, very involved in it. It's less on the individual fundamentals of each company and much more about the aggregate macro backdrop for the entire market. It's about earnings overall. It's about interest rates. So these large institutions actively trade the S&P 500. It's the most liquid futures contract in the world. And so they're trading options on futures. They're trading baskets of stocks. They're trading the futures contracts. They've got all sorts of different positions. And these buy and sell programs are algorithmic. And so that's how the measured moves come into play. There is some predictability. So that's really what we're trying to do. Market first. The market is our primary focus. So I'm going to add a couple of things here. And I'm going to add the 100-day moving average. I'm going to add AVWAP-Q. And I don't really need to add much more than that. But you can see now all of a sudden we've added some things to the chart and it gets a little bit more confusing. And what you'll oftentimes see is that traders in this area here, it's like, oh my God, lower, high, double, top, breakdown below AVWAP-Q, breakdown below the S&P 500, short, 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 short. Well, if you're doing that on a swing basis, you're going to regret that. Why? Because the market is in a bullish cycle. The 50-day moving average is above the 200-day moving average. So the way that you should be looking at AVWAP-Q, first and foremost, and I anchor it to triple witching, I believe that's when institutions are rolling positions. That is the basis for their beginning of the quarter, and those algorithms reference it. And because it resets every quarter, so there was AVWAP-Q, there's the new AVWAP-Q, and you can see this is the March contract. It resets, so it's often the very first line of support. So when we see a dip below it, we expect it to hold. So your entire mentality, again, the market is almost always in a bullish uptrend. So your focus should naturally be on the long side. One other thing that I'm going to point out is that when you start getting this golden cross, you'll also see how the major moving averages are mixed. We've got the 200-day above the 100-day. We've got AVWAP-Q below all of them. And now all of a sudden they start to converge. Well, this is another sign that there's a possible trend reversal. And while these moving averages are mixed, you know that the trend isn't quite as strong as it is when they are all in alignment. So here you got 200, 100, 50-day AVWAP-Q. When you have this alignment, okay, the shorter term moving averages are above the longer term moving averages. This is when you've got very strong trend strength. And you do have it back in here. So this pullback, instead of instantly flipping to, oh my God, the 100-day moving average got breached, I am so bearish, you should be in, hey, That 100-day moving average is breached. We are in a bullish market cycle. I am going to be waiting for support when this move can't get back above the 100-day moving average. All that tells you is we're likely to test the 200-day moving average. If we test the 200-day moving average, that is going to be a really good buying opportunity because I am in a bullish market cycle. So you get your poke below the 200-day moving average right in here. And look at the price action once we get back above it. Super, super strong, okay? And this is where we had the golden cross. So that little poke, yeah, this is a little aftershock. You're still trying to transition from a bearish market to a bullish market. But that was a nice move once you got through all these moving averages. Very sustained. Look at that. That is beautiful stuff. All right, so now we start testing a VWAP-Q. We get up to this level right in here, and I'd mentioned to you that was a measured move. All right, let's take some gains in here. Let's see what happens next. So on this next fall, I'll show you another measured move. You have that peak to that low. I'm going to measure that distance, and I'm going to subtract it from that low. Guess where you end up? Hey, cool. All right, so that tells you that was a measured move. This is going to be a good buying opportunity. I'm not going to jump on it. I'm going to wait for this breakout right here above the 200-day moving average. All right, I'm in there, and I've got to move above a VWAP-Q. Awesome. Hey, look at this. Now we got above the 50-day. We got something going here. Now we got above the 100-day, and we're also above this downward sloping trend line. This is the ultimate sweet spot, and this is where we were in November of 2023. And I told all of you, buy like there is no freaking tomorrow. And we were looking for that move back in here. I was already warning all of you. Don't get bearish in here, okay? Look at the long side only. That's all you should be looking at. You should not be shorting. Be ready to buy, and when we get that buying opportunity, you're going to be buying with both hands as much as you can, and you're going to be looking for every opportunity to add. And then we get this most unbelievable rally that lasts from November till about March or so. So even then, we can expect a pullback, measured move, add it up. All right, get you right up into this level here. So now what we're watching as the market pulls back is what is it doing around these levels? And again, your thought process is not, oh my God, VWAP-Q got breached. That's bearish. Oh, there goes the 50-day moving average. This is bearish. For some reason, as soon as you start adding stuff to the chart, traders' minds go absolutely bonkers. Nope. Bullish market cycle or not, this time is different. It's different. This is going to be a correction. I can feel it in my bones. I just know it. So instead of thinking, oh, nice, I'm glad we got this drop. Hey, we dropped below the 50-day moving average. I'd really like it if we got down to the 100-day moving average. Well, that's exactly what it did. And in here, you're not fearful. You're thinking, my God, this is going to set up to be a great buy. I am starting to salivate right here. But that's not what a lot of traders do, is they get all freaked out that they wanted to buy up in here. So now they get flushed out, okay? Bad move. You should have been taking profits in here, and you didn't. And now you get your ass handed to you because you stayed in the position too long. You didn't pay attention to the price action, and the measured moves helped us. So now you get this big drop, and you've looked back and you're thinking, oh my God, all the money that I made on these positions, I've just given back in just a few short days. Or maybe you were even adding up here, and now you've got your butt handed to you. And this just puts you in a foul mood. So no, I'm not looking at any of this as a buying opportunity. Dang it, this is going to roll over. I'm going to short this thing. So you miss the entire opportunity, okay? It's just so dang important, okay? What kind of cycle are you in? Well, this was a tremendous buying opportunity. And so we didn't spend time hovering around the 100-day moving average. As soon as we got back above the 50-day moving average and AVWAP-Q, this was a sweet spot. Yeah, awesome. I got a ton of cash on the sidelines waiting to deploy. Bam. Look at that freaking move. Okay, where do we go from low of 513 to 565? That's a huge move. That is a 500-point S&P move. Just with a little bit of timing. That's all we needed. Just with a change in your mindset. Bye-bye-bye. 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 Never, ever entertaining the short side of the market. No shorting. This is long only. If you can do that, it's really going to help you. Okay? So I've just kind of gone through a couple of key concepts. One of them, Golden Cross, 50-day, 200-day moving average crossover. Boom. We are in a bullish market cycle. From that point forward, we are only thinking about buying. When we do buy, we're going to use measured moves to help us gauge how far that move is going to go before it hits resistance. When we start hitting that resistance level, we're going to be watching for price action that's consistent with the momentum starting to slow down. Tiny bodied, mixed candles with overlap on light volume tells us that there are some sellers out there. We take profits and then we wait for the next dip. We evaluate the dip. If we start spending time around AVWAP-Q and we can't, boom, bounce right off of it, then we're probably going to test the next support level, which would be the 50-day moving average. When all the moving averages are aligned, that tells us that the trend is even stronger. So we start spending time around the 50-day moving average and below it, we're probably going to test the 100-day moving average. Well, we find support above it. But if we kept waffling around the 100-day moving average and we're not able to distance ourselves from it, it tells us that buyers are not that aggressive at this point, at least not yet. Okay, then we're probably going to visit the 200-day moving average. And when we visit the 200-day moving average, we ain't going to be there very long. And it's going to set up something special. And we're going to wait for that opportunity. So these moving averages, you should just look at them as safety nets. Okay? So if we break one safety net, it's okay. We got another one. If we break another safety net, it's okay. We've got another one. Ultimately, whichever safety net holds, then we want to see a big bounce off of that because that tells us that buyers are aggressive, and we already know that asset managers aren't going to be particularly interested in chasing, but they want to buy dips. And when the asset managers are in there aggressively buying dips, what do we know about programs, buy and sell programs? They're passive. These large institutions, these executing brokers like Citadel, they can see these orders coming in, okay? In here, they can see all these orders. They're not going to be running these buy and sell programs. They're not going to fight it, all right? So when you get these moments in here where you lift off of these major support levels, they're aggressive. Asset managers are aggressive in here, and the volume is heavier. So you don't get this back and forth chop during the day which is very difficult to trade because those are the programs. When you start getting this back and forth, up and down, red candle, green candle, red candle, green candle, mixed and overlapping, this is where the programs are taking over. And this is your sign to take profits. So you're using those measured moves. So I'm writing all this in my book. I thought I'd share it for you. This is what your mindset should be, and consistent with that right now, your mindset should be, okay, I am in cash. I'm waiting for a dip. Which one of these safety nets is going to hold? One of them's going to hold. I don't know which one it is. Are we just going to bounce right off the 50-day moving average and AVWAP-Q? Well, if we're going to, we don't have much of a running start into the all-time high. So we could inch higher. I'd prefer to see a little bit more depth to this dip. And then we should get a nice release higher. While I'm waiting, what could possibly happen? The dip could be deeper than I expected. We could see some pretty heavy selling pressure. We could see some profit taking. I'm not pushing the envelope here. I'm in cash. All I'm going to do is wait and evaluate at the beginning of 2025, and I'm going to see what type of dip we actually get. And in here, if I see us take out the 50-day and AVWAP-Q easily, and then we struggle to get back above it, I'm going to go, you know what? I don't need to be aggressive in here. Maybe I buy right in here, but now we're just kind of not getting that follow through, and we're just sitting right at AVWAP-Q and the 50-day. This is not what I want to see. This is not the follow through I need. I'm going to start taking my positions off. No harm, no foul. It's basically a scratch. And then, whoop, my suspicions are right. Now we took out the 100-day moving average, and now we're down to the 200-day moving average. Nice little rally in here. I'm not going to buy on that cross above AVWAP-Q because we're not through the 50-day and the 100-day. So I'm going to continue to wait. All right, now I get that move here. That coincides with the measured move. I'm looking for a bounce. Look at that beautiful, strong price action through AVWAP-Q. Here, would I add? Not necessarily. Let's see what we do at these moving averages. And once we blow through that downward sloping trend line, this is the sweet spot. This is where it starts. So I don't need to be very aggressive in here because this has been a nice pullback. But this is where I get aggressive. So hopefully that gives you an idea how you should be approaching the market from a trading standpoint. This hopefully helps you identify where your odds are. You got a few nice tools that you can use in terms of measured moves. This is how you should be looking at the moving averages. So stop looking at the moving average breaches as bearish. They are not bearish. They are simply probes for support. And when we confirm that support, yippee-ki-yay, we are going to get a nice move to the upside. We are going to be joining that longer term uptrend. Odds are going to be favorable. They're on our side, and we can expect some really nice, fast-paced movement through these price points. Call debit spreads at the money. Great strategy. Strongest stocks. That's where you want to strike. You start flattening out. Can't get through the prior resistance level. Take your gains. Wait. Next dip. Repeat. That's what you keep doing, especially as you get into this choppy type of price action late in a bullish cycle, early in the bullish cycle. When you get this type of price action, buy, add. Take your gains. Whoa. A move like this can set you up for years if you're adding and you're leveraging and you're confident in the move. So hopefully that gets you in the right mindset for 2025. Right now, we're just evaluating. So I'm sorry that I don't have a pick for you. But again, if I started feeding you, I like this stock, this looks like a good bullish pick, I like this stock. This looks like a really nice short. Then you're going to be in there trading when actually all you should be doing right now is evaluating. That's it. Okay? We're directional traders. We don't always have really high odds of success, and we have to wait for those odds of success to line up. And if we're not patient, then we're going to be in there losing capital when the market is not giving us ideal situations to work with. So please keep your money on the sidelines. Let's wait. Let's observe. Let's see what the market gives us in the first couple of weeks of January. And when I get my bearings and I'm able to evaluate that little move lower, then of course I'm going to have some great picks that we can be taken advantage of. Have a great new year, everybody. I hope you enjoyed your Christmas and your Hanukkah. Lots to look forward to. We had a great year in 2024, and we're going to keep that going in 2025. Trade well. We'll see you soon.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.